everyone. We're going to go through some sales tax reform. Now, this is one of the earlier presentations as part of the Eide Bailey Business Trends series. Obviously, many of you on the phone or on the webcast have either heard about the sales tax changes. I mean, I think pretty much things are never going to be the same. So we're going to talk this for the next hour about what's really changed to this. Some of the info, it might be repetitive of what you've heard before if you've attended any of our webinars, but we're also going to talk about how to navigate through this new world, a whole new world of sales tax over the next year, and some tips and tricks, and definitely some of the new rules that we're seeing some of the states come out with, especially recently. So my name is Laura Robichaux. I am actually in Denver today, and it's snowing, but I am based out of the Phoenix, Arizona office. So as a desert person, I don't do well in the cold weather. We're going to go through just quickly the agenda. I'm not going to touch too much on the actual basis of the Wayfair decision. I think a lot of people are, kind of have accepted the fact that things have changed, and we're not going to dig into the history too much. But we are going to discuss it a little bit because it might be relevant to some of the states and why they're changing the rules and the way that they are. We're going to talk about NEXUS, which is the big new word nowadays. There's a lot more aggressiveness coming from the states. We're going to talk about that. We're also going to talk about how to stay in compliance, and it's becoming like a complete mess. And maybe that's the best way to describe it. Instead of calling it sales tax reform, we can call it the sales tax mess. To kick it off, we're going to talk about the QUILL case. Now, QUILL was really kind of epic back in the 90s because the Supreme Court had ruled, hey, you have to have physical presence in a state in order to have NEXUS. And NEXUS, as many of you probably know, is it's the first step in whether you have to, file for corporate tax, whether you have to file for sales tax. It's the first step in any type of determination of what the state says you have a connection to us, you have to collect and remit. So when that was overturned in June, which we're coming up on that year mark, but when that was overturned, a lot of the states started to really get more aggressive in saying, oh, well, if the Supreme Court ruled it this way, then from this point forward, physical presence still exists, but it doesn't mean that there's more than just physical presence. Now there's all sorts of different types of NEXUS. So the big thing that I get a lot of questions about, and our Eide Bailey SALT team gets a lot of questions about, is, well, they think, who's a remote seller? A remote seller, I wish there was like a definite definition. Unfortunately, each state has kind of come up with their own way of describing what they feel is a remote seller, what they define as a retailer. A lot of wholesalers think that they're not retailers. Or we have a lot of variances in some of the consulting work that we do. It's really between someone who's a wholesaler, and that's the terminology within their industry. But from the state's perspective, anybody that sells anything is technically a retailer, whether you're selling it B2B or B2C. So a remote seller, I guess people still fax things, I don't know. So it's not just tangible property. I want to kind of, maybe we should update this slide to include, it does include sales as well. For those of us that are very well versed in the corporate franchise tax world, we throw out terms like cost of performance, and we're gonna dig into that later on in the hour. But services are taxable in actually quite a few states, surprisingly. So it's if you're providing services over the internet, if you're providing services over the phone, you're impacted by this. So it's not really a remote seller is not just the person who's selling, the widget, something you can like ship in a box. I realize this is an extreme example, but there is a place in Texas called Snow's Barbecue. They're a very famous barbecue place, and this is the line at 7 a.m. Snow's Barbecue is obviously very popular locally, but there's another picture of them internally. Because they have such great fame, a couple of years ago they decided, well, let's ship our stuff out online. During Christmas time, I always send out like Omaha Steaks food, sending out food. A lot of people think food is not taxable, and in a lot of states it is quite taxable. So Snow's Barbecue, which is one location out in Texas, again, this is an extreme example, you can actually go to their website, order the food online, and have it shipped somewhere else. I could order it and have it shipped to Minnesota or New York or whatever the case may be. And that's going to be taxable. So these changes affect, you know, a very small, what I call brick and mortar location in Texas, but because they're doing stuff online. One of the other things is people that do a lot of phone sales. So we have a lot of companies that we deal with that do, I guess, call center. Oklahoma is kind of like the call center of America. Phoenix is where we're getting close to that. Anything that you third party out, or you divert some of any incoming orders that you have, or even your business, is going to start creating NEXUS. And that's kind of, I guess, maybe what I was trying to get to in terms of the remote seller is, you know, who's really included in that. It's not just retail, it's services, it's even cloud. And I think I have a couple slides in here about technology, because technology companies are becoming more and more popular, and they're definitely going to be impacted by all these. And I don't even know if they're new rules anymore. A lot of them were in effect a couple of months ago. So one of the big questions I get is, okay, let's say we have potentially NEXUS in a couple of places. Do I have to register everywhere? Maybe, but probably not. And so there's 4 different types of NEXUS under these new Wayfair rules for sales tax. There's I'll start on the right hand side, the unique state. There's where they've kind of created their own threshold. There is a Wayfair checklist out there, but not all states follow the checklist. There's choice states that say, okay, well, maybe you don't want to collect tax in our state, but then you have to report all your customers. You have to tell us who you're sending stuff to. Washington has a notice and reporting. We're going to get into that. Colorado has notice and reporting requirements. The unique and the choice buckets are very small in terms of what all the states are doing. You're going to find, if you do an analysis, that most of the states are flowing over in this or bucket. There's a couple that have the and, but most of them are saying it's $100,000 or 200 transactions. We're going to dig into that a little bit too. So this is a map of the United States and this is, you know, actually this is a little bit outdated because it's from November. Obviously we've had some, you know, new changes from California recently, but this is just a high level, you know, view of, you know, which states are doing what. The ones that are in green are the ones that are following the Wayfair checklist. But any state that has color on here, it means that they're doing something for Wayfair. The big one that we're waiting to hear something on is Texas. Arizona might propose some legislation, but nothing's really been officially announced yet. Texas has a pending bill. California recently announced, and I'll get to that in a second, they recently announced that they have the $100,000 threshold for retailers, and the wholesalers fit in that definition of retailers, and then over 200 transactions. Now, there is a bill in California that is, and I can't remember the number of it, but it's basically saying that the threshold would be 500,000, which would make sense because that's closer to the income tax, franchise tax threshold. 100,000, when they came out with that publication, we were all kind of really shocked about that. So this is the list of states that'll have the or $100,000 or 200 transactions. I think, you know, having dealt with this for the past couple of months, I think the transaction quantity is not even really hitting a lot of companies, because, you know, if you did a couple of contracts, maybe you hit 100,000, but you only did 3 contracts. The quantity is really more focused. They put that threshold in place to capture the entities that are doing low dollar value, high frequency, high orders. So, and I think there's a couple of states that are even toying with the idea of removing the threshold for quantity and just keeping it at revenue. Here's some more of the or states, and I think that everyone will get a copy of this, you know, all the states and what their thresholds are, but we're waiting. Okay, so at the bottom here, you can see Texas is proposed for 500,000. We'll keep an eye on that. I mean, they're going into legislation now, so we'll maybe hear if it passes. I'm sure everybody's kind of keeping their tabs on that pulse. The ones that are really focused on growth states, I mean, Alabama is a big state just because they have multiple layers of jurisdictions. But these are the ones, I mean, Oklahoma is very low, $10,000. I mean, that's the outlier here. So we don't have to go through all of them. Tennessee and Connecticut and Massachusetts are the only ones that have the and. Okay, so this is another steakhouse that it's a restaurant, and maybe I think we're not getting too much into like the restaurant field, but it just to show that this restaurant, you can order the food online and have it delivered. So very similar to the Snow's Barbecue example I gave. And this isn't just for restaurants. Think about it for any nonprofits that sell. And I don't know if we have any nonprofits on the webinar, but nonprofits every once in a while sell, you know, items online, and then, you know, whatever revenues they receive from that, they use towards their cause. That can make a difference depending on how much they're doing a year. There's quite a bit of like monk missionary areas in the Midwest and the South, and believe it or not, a lot of those kind of companies have also hit the threshold in a few states. So they'll have to, a monkery will have to start filing for sales tax. Okay, so a polling question is, if anybody sells anything online, are they a true remote seller? So the polling question is, for those of you that want CPE credit, is the steakhouse a remote seller? The steakhouse that sells, you know, the food online, cookbook, spices, whatever the case may be. Would they be considered a remote seller even though they're just a restaurant? Okay, good. Yes, I think that's pretty obvious. We don't need to like drive that point home anymore. Okay, so I want to talk about Washington. Washington is a really big state, and Washington has already openly said that they're going to be really pushing compliance in 2019. And the reason why Washington is kind of a hot topic, at least in the sales tax world, is because they have really hefty penalties. They're becoming like the little sister of California, and their penalties are for non-compliance. And that's kind of the theme for today, is being in compliance for the year. So Washington, you know, probably one of the first states to come out with any sort of remote seller thresholds. They're saying, and Washington, for those of you that don't know, they have the retailing sales tax. And they also have what we call gross receipts tax, which is what B&O, which stands for business and occupation tax. So for the remote sellers, we're only talking about the retail side of it, the retail / sales side of it. And their threshold's $10,000, which in a lot of cases is very, very small. So even if you don't have people, property, you don't even fly over Washington on your way into Vancouver. If you had $10,000 of sales to customers, not billed to, but shipped to, wherever that person is that received your service or your property or inventory, that would create Nexus in Washington. They're really big on requiring people to collect and pay. They've been sending out notices for at least 4 or 5 months. They're going to run another campaign in the next couple of weeks. And what they're trying to do is Washington is trying to capture as many people as possible to file and register. So the threshold's low, and if they, I think the penalty for non-compliance is about $20,000. We wrote an article on it. I barely did a couple of months ago when we found out even if you didn't even owe any tax, you had an exemption certificate or something, if they found out that you weren't in compliance, they're starting to automatically assess $20,000. Now, there's a lot of, you know, grumbling about whether they can actually do that or not, and I think if they have enough information, they probably can. So for the B&O tax, which is the gross receipts tax, that's very similar to the Texas franchise, you know, margin tax, the Ohio CAT tax, the gross receipts tax, regardless of the taxability, your top number, if it's over 285, then you're going to have Nexus from that point going forward. And that's one of the other things, and I think I have a couple of slides in here too, is the effective dates for all the different states are really important. So if you're looking at if you're a controller or a CFO and you're looking at your gross receipts numbers as of today, and you look 12 months back and you're not at 285,000, then you don't have Nexus for B&O, but you're going to have Nexus for the sales tax rate if it's, oops, sorry, I clicked on the wrong thing, if it's applicable. So if they're trying to catch you on one and then the other, California is being a little bit sneaky like that too. So it's easy to be in compliance and file with Washington. The hard part is identifying which states you do have to file in, and I just would not want that penalty. Washington also has a use tax reporting requirement, and many of you, if you've attended any of these sales tax or even corporate tax webinars, a lot of firms, including us, are talking about the notice and reporting requirements. And Washington is, becoming a little bit more organized and strategizing. So if you sell something into Washington state and you don't have NEXUS there, you're required by Washington to remit a notice and reporting return almost, but it's kind of like an information sheet. I think is actually due this month. You would have to send it to Washington, and it would have to detail all of the things that you sent to them, to whoever it was, that individual, and the amount. Because what Washington's going to do is they're going to take that data and they're going to assess use tax at that level. And this is anybody that sells anything into Washington is required to comply with. We call it the notice and reporting standards. They also have a requirement that you have to have a use tax language on your invoice. So if you don't have NEXUS in Washington, you have to have some sort of language at the bottom of your invoice. And I actually think it's not a bad idea as a protection for your company. It reduces the risk. So the language is something like XYZ LLC doesn't have NEXUS in the state of Washington. You, as the recipient of this product or service, are required to remit use tax as applicable to, local municipality rules, state rules, something like that. You're supposed to have something like that on your invoice, on your website, whatever you're using to calculate the tax. Most of the big players in the field will allow you to add up to, like 180 characters, probably even more than that, at the bottom of an invoice, so it's pre-printed there for you. So that's the notice and reporting. Colorado, this is the other interesting thing that's happening. Is Colorado, if any of you have ever had to deal with an audit in Colorado, it's not the most fun project you've ever worked on. The cities are quite aggressive here. Probably, I would say, a little bit more aggressive than California at the state level. So California, and this is an old rule, but they're pushing more of compliance. Of, we want people to be in compliance, and if we catch you, we're going to assess you a penalty. And we've had some of our clients get these penalties. Really haven't had a whole lot of luck getting out of the penalty without good documentation or good facts to back it up. So Colorado is another state that says you have to have the required invoice language on there, and if you don't, they're going to charge you $5 for each one that you don't put the language on. So if you want to add that up, that seems kind of silly, but that's the fine that they assessed for each one, and that's by invoice. So if you did 1,000 invoices, that could add up. The same thing, Colorado's also requiring that you have to send a summary to your client by the end of the year, I guess, the calendar year. And if they audit your client and they find out that you as the vendor didn't give them a summary at the end of the year, they're going to charge you $10 for each one they catch you on. And then the annual summary to the state. So if you don't comply with their notice and reporting requirements, they're going to charge you $10 for each time they catch you in non-compliance. So if any of you have been through an audit and you do an error rate, a lot of times states will do error rates. I mean, if for every error, they charge you $10. That's not exactly, and I think it's kind of, this is just my opinion, I think it's a lot for an accounting division within any company to be compliant with these types of rules, especially when, Washington requires one thing and then Colorado requires something, similar, but, with, tweaked a little bit. So this is a recent news press release from Colorado. So they said now that their limits are going to be for 10,000 and 200 transactions. The important thing about the remote seller requirements is the effective date is important. So let's say Colorado, the top of the screen says must comply by 11/30/18. They did the press release on 9/11. So they only really gave people 2 months to get into compliance with either you need to do your notice of reporting, or if you hit these thresholds, then you need to start filing. Colorado timelines, and I would not maybe limit this just to Colorado. Washington also has some pretty interesting timelines. They want, so think of, I'm going to try to break this down without losing everybody. If we're in 2019 right now, if you realized that you didn't have NEXUS until maybe like, oops, okay, in October we found out we have NEXUS in Colorado. Okay, we're going to start filing in November. Colorado will go in and pick up anything that you did not collect on from that November start date back to the beginning of the year, those 11 months, and they're waiting to see if you will file a notice and reporting report for in January 2019. And the reason why is they want to catch you for the fees. So you have to kind of think, okay, if you realize, all right, we hit the threshold in Colorado, we're going to start moving forward with that, but also take into consideration that look back period of between the 1st of 2018 to when you started filing and collecting sales tax. Did you follow their notice and reporting requirements? And if you didn't, then you know, there might be some potential fees there if they catch you, or if you voluntarily disclose that you did not. Just something to kind of keep into consideration. Georgia, which we don't see a lot of audit activity from Georgia, but maybe that will change. Georgia also put out a new bulletin that said starting January 1 of this year, so not that long ago, you've got to also send the invoice. This is all notice and reporting stuff. You have to be in compliance for that for Georgia, and it's similar to Colorado where you have to send the annual summary to the client or the vendor or whoever you sent something to that sales tax wasn't collected on. Then you got to send the summary to the state. Then you got to make sure you have the language. What we're finding, if any of you are like, oh my gosh, if what we're finding is that a lot of companies are like, well, we didn't even realize this was a thing. You know, the states don't really publicize it. It's like sales tax collection is probably more of a thing than the notice and reporting standards. And it's hard because you can't really go back and try to fix it. A lot of companies struggle with identifying, okay, we sent out a bunch of invoices. How do we know we charged tax on it? Maybe that's hard for you to extrapolate, especially if you use multiple systems, which maybe some of you do. You know, you have one system for this, and then you might have to reconcile it to your other system. It's hard. It's not easy to get to that information, I guess is what I'm saying. So just something to consider. Pennsylvania also has the notice and reporting standards. It's on the DOR website, and look at their fines, 20,000 plus. I mean, that's a lot bigger than Colorado's, but maybe if you know you got there. Washington's are pretty hefty too. Rhode Island is incorporating this language, and the hard part about it, and people, I get this question all the time from CFOs and presidents of companies. They're like, well, how are they going to find out? How does the state know? The main way the state's going to know is if they audit someone you've done business with. If they audit someone you've done business with and the auditor's savvy enough to pick it up, that's probably the most likely way that they would find that you didn't comply with the notice and reporting standards. Vermont, there's another one that has required language. I mean, you know, Vermont, what was the other one? Rhode Island, Georgia, Colorado, Washington. Oh, here's the other one. Washington's fines are also $20,000, so they're in line with Pennsylvania as well. I'm going to kind of skim through this because I think I'm falling a little bit behind. Not to skip through this really fast, but this timeline thing, and maybe we can present this better in a different way. So if you come into compliance later on in the year, don't forget that in the earlier parts of the year, those states that have the notice and reporting requirements, only the ones that have it are wanting you to remit that information for that calendar year period. Next polling question. So this is the polling question. I have never left my dealership in Eide, South Dakota, but I have traded a used combine to a dealer in Washington for a baler and cash. A third party hauled the machinery, and this happens a lot, right? You sell something to somebody, a third party delivers it. You know, who knows? Is it possible I could be subject to Washington business and occupation tax, also known as Washington B&O tax? Great. Yes, it is possible that you would be subject to Washington B&O tax, which is the gross receipts tax, that $287,000, depending on how big that sale was. And it definitely, if it was over $10,000, then you would qualify. You would have requirement to collect from the $10,000 retail threshold. So I realize the polling questions are kind of a little bit cheesy, and they're meant to just kind of think about things in a different way. A lot of these activities, especially if you sell an asset, mean, there's some states that even tax the sale of assets. Oklahoma has a whole audit division just for any asset sales that happen. Like if you're planning on selling your company, even if it's a stock sale or just an asset sale, I mean, those are this whole compliance situation we've got going on in 2019, this whole mess. I would take a really good hard look at it if you're planning to go to market in the next couple of years, because what will happen is if any non-compliance comes up in the due diligence process, it either will affect how much you have to hold in escrow, or it will affect the sale price. So Eide Bailly, if you were to go to our website and hit the search function, we do have a lot of information out there on Wayfair just as a resource. We're constantly updating it. If you were to go to the SALT page, we have this change ahead sign. We're going to kind of keep that icon. We are constantly updating this chart. So on our website, we have the chart with all the states and all the different requirements and all the effective dates on here. So we also have the ones that talk about, you know, there's been no guidance issued. So for example, DC hasn't issued any guidance, but they're definitely going to. Arizona, the same thing. So we're just kind of waiting and seeing. So if you want to keep track of this and you're one of those like really good go-getter, do your own research, this is a good resource. And I guess Google is too. So which I know everybody kind of goes to. All right, so income tax. How do these Wayfair changes impact me on an income tax level? I can tell you that it's from a compliance standpoint, it's going to vary. So a lot of companies that sell what we call TPP, which is tangible personal property, they talk about, you know, maybe I'm protected by 86-272, and that might be true, but I think over the past couple of years we've seen a lot more cases where clients take the perspective of I have 86-272 protection, but when we start digging into the facts, you know, there's other things that will create nexus or physical presence or something like that. So from an income tax perspective, I would definitely recommend consulting whoever you are working with to file your corporate tax returns, because what's happening is those of us that are filing in, like, let's say 5 states, okay, Wayfair happens, poof, now we're going to file in 10 states. Well, that income, and that will, if that state doesn't have 86-272 protection, which would be any gross receipt state, you know, you might have to file a corporate tax in that location. If you've added a lot of salespeople, this is like a really big deal now. A lot of people have got sales folks all over the place, even if they're 1099, even if they are just, hey, I work out of my home and I do billing or I do phone support or whatever, that creates physical presence in a state. So it doesn't even really matter. So there's a lot of different nuances about it. I would just be really careful. That's one of the things as we work with our tax partners within the firm, is we're really focused on, okay, where do they potentially have sales tax issues? Where might they have nexus? And then how does that look from a corporate tax side? Because depending on your entity structure, I mean, California, the one that's the state that scares everybody, depending on your entity structure, it could impact the partners / shareholders on an individual basis in that state. They would have to possibly have to file non-resident returns or a composite return or something. So just to kind of keep that in mind, a lot of people have done tax planning that mainly happened in December. If you got through your year-end inventory and that whole thing's over with and you want to start digging into this, look at both tax types. That's my recommendation for if you want true compliance. If you can't get 100% there, get at least 80% there by looking at both. So apportionment methods, there's still the 3-factor, evenly weighted, double weighted, 3-factor, special weight, and then there's the single sales factor, excuse me. A lot more states are going to start coming out with the single sales factor in terms of sourcing. Now this is important because sourcing is going to be different depending on whether you sell tangible property or you sell services. Because if you sell services, then the whole cost of performance sourcing comes in. So sorry, this is in black and white. I'm going to try to find a colored one for next time, even though this is a little bit old. So this is just the states. Look at the ones that are darker colored, darker shade. Those are the ones that have single sales factor. And if we fast forward to like now, almost all the states have some sort of carve out for the sourcing of services. So and I guess we get this question actually quite a bit when we're trying to figure out when we're to do extensions. The cost of performance. So let's say we are in, I'm in Colorado today, but we have a a location. We have a bunch of people that do. We have clients we service in Texas. Well, Texas is a cost of performance state, but if we're in Colorado, it's going to be sourced back to Colorado, and that gets into the whole throw back, throw out. But it really depends. So just pulling your sales by bill to is not going to be as great of an information from a validity standpoint as it would be if you start digging into more of these things. But it really is going to depend on what kind of company you are. Generally, you're going to want to look at all the states that have new sourcing rules. So probably 5 or 6 years ago, we had a ton of states that were not as many market-based. And when I say market-based is very similar to economic presence-based. Market-based is all about where is your customer located. Colorado is going to change from a cost of performance to market-based states. And the only reason, and just from a historical perspective, that people are switching from cost of performance to market-based is the same reason they changed all the Wayfair rules, right? They're trying to expand and cast that wider net to gather more money into the state. It's really always, I feel like everything comes down to money. So this is the list of all the states for those of you that maybe prepare your returns internally, or you want to double check to make sure your accounting professional did everything correctly. These are the market-based states. And you can see here, Kentucky switched last year, Colorado and New Jersey are switching for this year. So when you file in 2020, it's going to be for market-based. We are anticipating in the tax world that because so many states, almost 90% of the states jumped on the Wayfair ruling for economic presence, that we're going to see more bills introduced over the next few years, changing the cost of performance states to market-based states. Oh, so good. Here's the list of states if you wanted to look at this. The ones that have the throwback and throw out rule. The ones that are green on here, those are the ones that they don't really have like the gross sales, but they have the other gross receipts tax. So Ohio has the CAT tax, Texas has the margin tax, Nevada, which is the one we get a lot of questions on. Nevada has that new commerce tax, but what people don't realize that Nevada and Texas, maybe you didn't meet that threshold, but you do have some sales there, depending on, the materiality of those sales. They want you to file an informational return. So the Nevada haircut, I think, is $4 million. Let's say you only got to 2 million. I think that $2 million is plenty, in terms of materiality, that you would want to file a Nevada informational return. So that's just kind of something to be aware of as we move forward into 2019 from a compliance standpoint. So we have, I think this is the second to the last polling question. It's a true or false. So is there updated and important information about the state responses to Wayfair on the eidebailey.com website? So is there some information, or is there not any information? Okay, thanks, Amy. Yes, there is information on Wayfair. We probably should make these like really super complicated. But yeah, and we always have putting stuff out on our website, and whether it be an article or something like that, to kind of keep everybody updated, since I know it's kind of hard to find time for an hour to carve out in your schedule to go to a webinar. Okay. Wow, this is a big sign. So this is just, I want to kind of caveat this with, this is what is happening today. It's not necessarily what's happening, we could be painting a very different picture like 6 months from now. I mean, that's even true on the Wayfair side. I mean, look how many things have changed in the past 6 months. I mean, who knows? So we're kind of just caveating that of changes are still coming, especially now that different states are gone into session. Probably around June is when we'll find out when a lot of other changes have happened that are going to require compliance from different types of entities. I would really, really, really caution everyone from, if you're one of those people that likes to go out and do their own research and you realize, okay, I've hit the thresholds in like these 6 states, I'm going to go out and register. I would maybe slow down a little bit and think about it from an analysis standpoint, because and it's especially with some of the bigger states like, you know, California, Washington, some of them, when I say bigger, I mean aggressive states, North Carolina is getting up there too, is you could have some look back issues. And this is what we find out when we go in and we try to help clients. We go in and we look and say, okay, let's say Washington State, for example. Okay, maybe you thought, oh, I hit the threshold. But what you may not realize is that you've had someone there who's been working remotely as a 1099 person. Even though they're contracted, Washington State would still view that as physical presence. And therefore, you have had NEXUS for like 4 years. So by coming into compliance, you could potentially increase the exposure. So before going out and signing up for all your sales tax licenses, I would just maybe do a little bit more in-depth analysis. That's what we're kind of saying. That's what we're recommending, because and this, you guys are going to, let's say somebody goes to market, wants to be sold in the next couple of years. I would do it now before waiting. There are options. One of them I think we have listed on here is what we call a VDA, which is a voluntary disclosure agreement. It's pretty much like coming clean to the state. They waive penalties, not interest, but it pretty much, there's a lot of benefits to doing a voluntary disclosure. So there's an option for companies if you find out that you have prior year exposures that you want to kind of, you know, clean up and move on with in the next year. There's a couple of things that we do at Eide Bailey, and let me see if I have an example on here so I can show you guys. So this is, we call it the one pager. And what we do, we have this for sales tax, we have this for income tax, and we also have it for all the notice and reporting states. So we use this as a tool. It's not a NEXUS study by any means. It's definitely not like a taxability study, but we use this to figure out where companies have hit NEXUS for sales tax using all the new Wayfair rules, and where companies have potentially have issues on the income tax side, kind of like a heat map on where to look. And for notice and reporting, definitely if you're an online retailer or you're starting to move into that e-commerce world, and which a lot more companies are doing now. So we have this, we have it available. It's fairly cheap. I just want to preface that it's not a NEXUS study, but it allows us to take like a top-down perspective and look of like, okay, where are some of the states that we have some material exposure, if any, and then, you know, kind of start to develop a compliance plan. Because this year, I think the theme is compliance. I mean, it is just, it's a lot. It's going to be a lot of cleanup and figuring out on how to do things. And the second part of that is, once you figure out where you have NEXUS and what to do, the second question is always, okay, well, I might have NEXUS, but am I taxable? You could be somebody who sells something, you know, 100% to business, or you're a wholesaler 100% across the board, or you sell to not exempt entities, or you're a federal government contractor. There, in all the research we've done, we haven't found anyone that's totally exempt from the NEXUS rules, but you may have different factors to your benefit if you are taxable or not in that state. And that's more of like a business decision you kind of have to think about. So we have that. And with that, this is our last polling question. And I want to be able to get to everybody's questions and clear up any issues if anyone has anything. So the last polling question is, did you find this webinar helpful? Yes or no? And then, or yes, I'm looking forward to learning more. Okay, questions. For the question box, when does this go into effect? Do we have it for 2018 as it relates to Colorado? Was the notice and reporting on the state level? Oh, okay, that's actually a great question. I believe it went into effect in 2018. And for the notice and reporting, it is at the state level. So yes, we're kind of like waiting to hear what the local levels do. I mean, Denver is, they're just kind of like their own mini states within the state of Colorado. I mean, the city of Denver is obviously like the big city in the state. We're waiting to see what they do, and that's the big question, right? Because Colorado is one of those home rule states, like Arizona, Louisiana, even Alaska, even though they don't have a sales tax. And the home rule state just pretty much means that the local municipalities have a different set of tax rules than the state level. So yeah, it went into effect in 2018. So that's kind of like the time, to answer your question, Kathy, it's kind of like the timeline is really important depending on, you know, when you started sending stuff in there. And it's all case by case basis. So let's say you sent like 1 or 2 things in February, right? And maybe, yeah, like 3 or 4 months, and then maybe you send something else in on August. I mean, then it really depends. But if you're regularly shipping stuff or doing stuff in Colorado, then you might want to take a deeper look at it. That would just be my recommendation. Okay, Kathy, you are located in Colorado. Oh, so you know all about the local many states within Colorado. Okay, so if you're in Colorado, if you're based in Colorado, then you don't have to comply with the notice and reporting, because I'm assuming you already collect and remit to the state of Colorado. The notice and reporting is really for out-of-state companies that aren't licensed, that need to comply. So I guess maybe the question, not to kind of clear up any confusion, is that you don't really need to you don't have to consecutively do both unless you have one of those weird timeline issues where you cut in the middle of the year. But if you have a Colorado license, or maybe you do business in a couple of the municipalities, then you don't need to do notice and reporting if you're based here. So thank you. That's actually a really good question. I'll add that to my next presentation to make sure we talk about that. From Christy, if you have FOB shipping point terms, but the destination is in another state, do you have to collect and pay sales for the state of destination, or is it the NEXUS piece? Okay, let me make sure I understand the question. Terms, but the destination is another state. Do you have to collect sales tax? Okay, so someone else is picking up something and you're delivering it to another state. So the whole economic presence is, if you are, even though it leaves your warehouse, it separates from the building, it's someone else's, third parties handling the transportation of it. It's all about where for sales tax, it's all about your customer location. So regardless of what kind of terms you have in your contract, I think for sales tax, they're almost completely irrelevant because you can't really transfer tax liability. It's all about wherever the destination is of that thing that's going there. So I would track it that way. But it's not a bad idea to look at if you have terms, maybe you want to revisit your contract too, to make sure that that's updated based on the economic nexus rules. But for tax, sales tax, it doesn't really matter. It just matters where it's going, where it lands, final place, resting place. I hope that answers your question. For Adam, do these changes have any impact on excise tax reporting? Not really. You'll find that all the changes are specific by tax type, because I actually have quite a few clients that do different, they're in multiple lanes of revenue. No, it's just for sales tax reporting. And then the corporate tax, we are going to anticipate quite a few changes. Maybe if it's not some this year, but probably a lot more next year for compliance issues. The states that have reporting requirements on invoices, does this include services or just tangible property? That's a great question. It depends, which is my favorite answer. It depends on whether that state taxes services. So like Texas taxes some services, Washington taxes some services, New Mexico taxes some services. So we would really need to kind of know where it's taxable, I guess. But the reporting standards, well, I guess it's kind of hard to accrue use tax on services, isn't it? But if it's taxable to that state, they would want you to accrue use tax. I think a lot of times companies think, well, use tax is just if I bought something on Amazon and they don't charge me tax, and I have to accrue use tax on it. It's not necessarily that. A sales tax auditor will look at anything that doesn't have tax on it, would be automatically flipped over to use tax, unfortunately. So that's a great question. Okay, Susan is the statement that needs to be put on an invoice listed on the EB website? No, it's not. But if you're a client, I can email it to you. But also, so we give you general language, and we're not lawyers. Well, I'm not a lawyer. So we can give you some general guidance language. And in fact, if you go to some of the states' websites, like Washington, for example, they give you some general language for free. You can take that general language from the Washington website and you can throw it to whoever your internal or external legal counsel is, and they can, massage it and make it perfect. And then that's what you can use. That would be my best suggestion. Anonymous attendee, thoughts or opinion on using a third party like Avalara? So Eide Bailey partners with Avalara. I personally have used Avatax. I've used their exemption certificate monitoring program, which if you're a B2B wholesaler type of company, that's a great product. I think everything depends on what type of business model you are and where you see yourself in 5 years. If you're on a humongous growth trajectory and you're hitting NEXUS all over the place, Avalara is a great product to use. I would recommend them. But before you go and sign up everywhere, kind of think about like what are your business needs from a sales tax standpoint. Jason, I work for a very small technology company that will be selling services online. Okay, cool. Are there technology-based tools that will help us stay in compliance? Yes, there's a gazillion of them. If you're a technology company and you're selling services online, I guess it really depends on kind of like what you're doing. We have quite a bit of hacking companies. Like there's different types of services. There's cloud services where you provide services when we say online up in the cloud, and someone like me in Colorado can access it via the cloud. And if you're providing those types of services, you might be considered SaaS, which is software as a service. Now that's taxable in about half the states. So if you're looking for compliance, I would start with where do you have NEXUS? That's always number one, because you could be taxable somewhere, and if you don't have NEXUS, it doesn't matter. So I would say start with NEXUS, then start with where you have taxability and kind of start like chipping away at that list. To stay in compliance, if you're a small technology company and you have a finance person or a tax person that you trust, have a conversation with them about, this is where these are the markets you're growing in, and kind of make those business decisions on if you need to start activating your NEXUS there or going forward. Now, most software companies, when I say software, I mean sales tax solution companies or any type of online monitoring is going to have some sort of sales tax component, but I think it depends on what you really need it for. But there's a ton of them. There are a ton of them. So Anne has, where does responsibility lie when using online retail fulfillment services? Oh, fulfillment by Amazon. Okay, this is a great question. So I don't know how many people on here, and I know we only have 5 minutes, so I'll try to talk fast. So Amazon kind of, well, I don't know what the whole story is, but the state of California went after Amazon quite recently, and well, they have been for years, but quite recently, Amazon had to disclose every seller that has ever flowed through their system, FBA or not, which, so just everybody knows, FBA means fulfilled by Amazon, to the state of California. And then California went out about, I don't know, maybe a month and a half ago and sent all of those people that had done business with Amazon a letter that said, hey, you need to come into compliance. We have these new rules effective April 1, 2019. So here's the question. Here's the best way I can answer that, Anne, is if you sell your inventory to Amazon, I have seen it where you can ask Amazon for an exemption certificate, right? Because they're going to resell it for you. But if you have a bunch of pallets, they get dumped in from a port in California, an Amazon sorting center takes that inventory, spreads it out all over the place based off of where it's most likely to ship fastest from. It's still your inventory, and they're just selling it for you, right? The rule of thumb in the sales tax world is wherever Amazon has a distribution facility is where you technically have NEXUS, because you have quote unquote inventory in that state. Amazon has quite a few different programs, but if you sell through Amazon but you control your own inventory, then that's different. Amazon is just simply acting as like a marketplace facilitator, right? But you hold your own inventory. So inventory creates physical presence all over the place. That's why Amazon a couple of months ago started making their inventory reports a little bit more robust, is because all these Amazon people, whether they were FBA or not, were getting audits from certain states, and they couldn't snapshot where their inventory was from a certain period of time because they're always moving it. I mean, it's almost impossible, and the report is humongous, but that's why they bumped it up. I would say I would look, depending on how much of percentage of your sales are through Amazon. If they're 100% through Amazon, you might want to look at that a little bit more. That would be definitely my suggestion. Okay, so with 2 minutes left, I'm going to run through this last question. If selling online in Colorado, do you have to say sales tax to each county? I'm confused on this. I'm located in Colorado. Okay, so if you have NEXUS, now we kind of always lump together normally state and county, and then there's like the local people. So if you are located in the city of Denver, then you have NEXUS in the city of Denver, whatever county the city of Denver is, which I don't know that, and then the state of Colorado. So you're going to really kind of have to think about, because Colorado is a home rule state, you might have NEXUS in the city of Denver, but you may not have NEXUS in, I think there's a place here called Loveland. You may not have NEXUS there. We're waiting for we're holding our breath on the local municipalities in Colorado coming out with their own economic NEXUS rules, because they are a home rule. We are a home rule state here. So I would say if you have a brick and mortar location, you're going to only have NEXUS in your brick and mortar location. But it also depends on how much you have in sales too. So I hope that answers your question. If it doesn't, I have my contact information in the webinar presentation. Anybody can feel free to reach out to me, and we can talk about sales tax anytime. Or, you know, if you need like consultation or you need help with anything, I'll be more than happy to help you kind of navigate through this mess of sales tax and all the new compliance crazy rules that are going on. Also, to kind of leave it and close the webinar, if any of you are interested in looking at maybe using Eide Bailly for our tool, just to kind of, you know, maybe you got a board meeting coming up, or you're meeting with the sales staff and you're like, hey, you got to tell me what states you're going into because it's important, we can help you with that too. So you can always feel free to reach out to me. Thank you.
Thanks, guys.